Responsible credit use builds a strong financial profile without overextending yourself. Always pay bills on time. Setting up autopay for the minimum due helps. Keep your credit utilization ratio below 30% on each card and overall. Only apply for new credit when necessary, as hard inquiries can temporarily lower your score. A long history of responsible use demonstrates reliability. In the U.S., good credit secures lower interest rates and can affect renting, insurance, and even employment. Start by using one credit card for small, regular purchases. Pay the balance in full each month to build history without accruing debt. Your credit report is the detailed ledger behind your score, compiled by 3 major bureaus. It lists your accounts, payment history, limits, and loan balances. Review your reports regularly for errors or signs of identity theft. Inaccuracies can drag down your score, so it's crucial to check them. By federal law, you get one free report from each bureau yearly at annualcreditreport.com. Stagger your request to monitor your credit continuously throughout the year. If you find an error, dispute it directly with the reporting bureau. They are legally required to investigate the inaccuracy. Your credit score is a 3-digit number lenders use to gauge your risk. Think of it as a financial report card. A higher score makes you appear more trustworthy to lenders. This directly impacts the interest rates you're offered on loans and credit cards. The score is calculated from your credit report, often using the FICO model. Key factors include payment history and amounts owed. You can check your score for free through many bank apps or services like Credit Karma. For the exact score a lender sees, you may need to purchase it. For long-term goals like retirement, use tax-advantaged accounts. In the U.S., common options include employer-sponsored 401(k)s and individual IRAs. Contributions to a traditional 401(k) or IRA are often made with pre-tax dollars. This reduces your taxable income now, and investments grow tax-deferred. Roth accounts are funded with after-tax money, so there's no current tax break. However, investments grow tax-free, and qualified withdrawals are also tax-free. Maximizing contributions to these accounts should be a top financial priority. The tax benefits compound dramatically over decades. Many investors use mutual funds and exchange-traded funds, ETFs. These are pooled vehicles that hold a basket of many different securities. A mutual fund is professionally managed, and you buy shares at the end-of-day price. An ETF trades on an exchange like a stock throughout the day. The primary advantage of both is instant diversification, which significantly reduces your risk. They are practical tools for building a solid investment foundation. Stocks represent ownership shares in a company. They offer high growth potential but come with higher risk and volatility. Bonds are essentially loans you make to a corporation or government. They are generally lower risk and provide steady income. For most beginners, a balanced mix of both is key. This builds a portfolio aligned with your risk tolerance and time horizon. Social Security provides a foundation of retirement income based on your lifetime earnings. Your benefit is calculated from your highest 35 years of earnings. You can start receiving benefits as early as age 62, but payments are permanently reduced. Waiting until your full retirement age gives you your full amount. Delaying benefits past your FRA, up to age 70, increases your monthly payment for life. Social Security is meant to supplement your personal savings. IRAs offer another avenue for tax-advantaged savings. They are useful if your employer doesn't offer a 401k or you want to save beyond its limits. With a traditional IRA, contributions may be tax-deductible. Investments grow tax-deferred until withdrawal and retirement. Roth IRA contributions are made with after-tax dollars. Qualified withdrawals in retirement are completely tax-free. A 401k is powerful due to its tax advantages and frequent employer match. Contributions lower your current taxable income and grow tax-deferred. Always contribute enough to get your employer's full matching contribution. This is essentially free money and an immediate return on your investment. Withdrawals before age 59 and a half typically incur a 10% penalty plus income taxes. The goal is to let this money grow undisturbed for your future. Integrate daily spending with long-term pillars. Your budget should allocate funds for retirement contributions and annual tax payments. Use automation to fund investment accounts right after payday. Treat these contributions as non-negotiable expenses. Schedule an annual financial review to reassess your budget and rebalance your portfolio. This holistic approach fuels your long-term security. Estate planning dictates what happens to your assets and dependents. At a minimum, this involves creating a will to distribute possessions and name guardians. Establish durable powers of attorney for finances and healthcare. This ensures someone you trust can make decisions if you become incapacitated. Regularly review and update beneficiaries on retirement accounts and life insurance policies. These designations typically override instructions in a will. Proactive tax planning legally minimizes your lifetime tax burden. This involves strategic use of tax-advantaged accounts like 401ks and IRAs. Be mindful of capital gains taxes on investments. A key habit is adjusting your W-4 withholdings to avoid large refunds or bills. Homeowners insurance should cover rebuilding costs, not just market value. Liability protection is crucial if someone is injured on your property. Renter's insurance is affordable and covers your personal property and liability. Your landlord's policy does not cover your belongings. For auto insurance, liability coverage pays for damage you cause to others. State minimums are often too low, so consider increasing these limits. Collision covers damage to your car from an accident. Comprehensive covers non-collision events like theft or weather. Health insurance is a critical financial safety net. Understand key terms like premium, deductible, copays, and co-insurance. Always check if your preferred doctors are in network to avoid higher charges. Adequate coverage protects you from catastrophic medical debt. Start by defining clear long-term goals, like retiring with a specific amount. Then, work backward to establish the needed monthly savings rate. Automate your savings transfers immediately after each paycheck. This is the single most powerful financial habit. Create a one-page financial dashboard listing your net worth and key documents. Review this dashboard quarterly to stay on track. Estate planning ensures your savings benefit the people you care about. It's for anyone with assets, like a home or retirement funds. Verify all your beneficiaries annually. Ensure your key documents are accessible to trusted family members or your executor. You are taxed on what you earn, invest, and leave behind. Maximize contributions to tax-advantaged accounts to reduce taxable income now. For non-retirement savings, consider tax implications. Holding investments for over a year typically qualifies for lower long-term capital gains rates. Do an annual tax checkup with your pay stubs and investment statements. This helps ensure you're not having too much or too little withheld.